guys, and welcome back to another episode here where we're going to be talking all things real estate and talking about what's going on in the market. Today, I have a special guest with me, Dion Beg from Butler Mortgages, and Dion's a professional in this field and has been working in the Durham region in the GTA with investors for a very long time and is very knowledgeable and someone that brings more to the table besides what's going on with rates. If you're looking to just find out what's going on with rates, he's your guy, but you get way more out of him besides what's going on with rates. If you want to talk macro, if you want to talk details as to what's going on rates and such, Dion's the guy. So Dion, thank you for joining us. Why don't you give our audience a quick introduction?
Yeah, sure. So look, I've been working in the world of real estate and finance for now just over 20 years. Some of that time was in Australia, which is where my accent's from. But for the last 14 years, I've been working in the GTA. Very fortunate that the hard work has paid off. And for the last 5 years in a row, I've been fortunate to be ranked in the top 75 mortgage brokers in Canada. And that speaks to the volume of business we do. We do a lot more volume than the standard brokerage. And that is because we work with a lot of clients who are repeat clients. We will help them with their first principal residence purchase. But my background is in financial planning and using real estate as a tool for financial planning. So after they make their first purchase, we set them on a path to get their second and third homes and show them how those other properties will get them debt-free, set up their kids, and set up their retirement. So as much as we are in the world of mortgages, we very much are in the world of getting our clients into a position of financial freedom using real estate.
That's awesome. Hey, Dion, is the mortgage world similar to the realtor world? Like, are there a lot of mortgage brokers similar to realtors? And is 20% doing the work of the 80%?
I think that, yeah, it is. I mean, it's in any industry is always the case, right? In that, that's very true. 20% are probably doing 80% of the business. And, I think you and I could probably agree on this point that people say, how are you successful in this business? I'm like, well, treat it like a job. And many of our counterparts don't treat it as a job. It's kind of like a pastime. But this is something that I know that you and I both treat as our true professions. Yeah.
Yeah, absolutely. And one of the reasons why, initially we connected through a Durham REI, and of course, since then we worked on some deals together. But what I like about you and your colleagues, what you guys do is run workshops for people. So you have a workshop coming up on September 27th. So why don't you give us maybe like a 30-second intro as to what it's going to be, and then we'll dive into the meeting.
Yeah, great. And I'm sure I'll provide you with a link, and I'm sure you'll put it somewhere for people to click on.
Right.
But on Tuesday evening, that's September 22nd at 7 p.m., we're doing a live free webinar. The title of that webinar is Protect, Prepare, and Prosper. And the reason that, as much as it's alliteration and it's 3 Ps, it sounds good, there really is some context there, some truth to it, because we're handling a lot of calls and a lot of clients this moment and helping them with these things. So protect would be make sure that your household is running well financially, that your cash flow is there, that you have liquidity and you have fallback positions, maybe home equity lines of credit and savings. Then it would be prepare. A lot of our clients are already at this point preparing, where they are looking at the market now together with their realtor like yourself, Saman, making sure that they're understanding where values are so that when the opportunity comes, they're ready to jump, right? And then prosper is obviously in the future, and I mean in the past and in the future, my belief is that real estate will always be a hard asset that people will need. Ultimately, we all need a place to sleep. And so a lot of our clients have this long-term belief that as much as we're going through some choppiness right now, that if they have a 5, 10, or 20-year vision, that real estate is where they want to be. And long-term, this is where we've seen people double, triple their net worth in a period of 10 or 15 years. So prosper is for the future as well.
Awesome. And in terms of helping people grow, right? Can you maybe give us a quick example of maybe a client that you work with that started with one and now is at a large scale, and just to, I guess, give people some context as to who you work with, the first time investor and the experienced investor?
Sure. So the first time investor is usually somebody who has their own home that they live in, and they might have lived in that home for 5, 10, or 20 years. they've heard about investing in real estate, but they've always been a little bit cautious, a little bit scared, rightfully so. Going into debt is a scary thing. The idea of managing tenants is a scary thing. So we'll generally hold them by the hand and show them the financial component of that, where ultimately, if we can set it up correctly, we'll set them up in such a way that the property they buy doesn't actually cost them in terms of monthly cash flow. The way we achieve that is obviously you've got to find the right property with the right rents, but also it involves some restructuring of other finances. They might have a $700 car payment. We might be able to restructure things so that payment ultimately drops to $100, right? Now we've created $600 in household cash flow. And that in turn then allows them to go off and borrow more and buy not a car, which is a depreciating asset, but a home, which is in general terms is an appreciating asset. We help people who've been denied by their own banks, saying, no, there's no chance that you'll be able to buy. And just with a little bit of restructuring, we will take that same client back to that same bank and get them funded, right? So oftentimes it's a little bit of the fact that the people who work at banks are very good at processing, but they're not very good at looking outside the box, especially when it comes to expansion of portfolios, right?
Yeah.
So that's where we would help a first-time home buyer. Then we'll have a more sophisticated buyer, a first-time investor. Then we have a more sophisticated investor client who might come to us with 4 properties. And again, they're sort of reaching what most banks would say is their absolute cap. We cannot lend you any more money. Your debt ratios are too high. We have too much exposure to you as an individual. And again, we'll take those same clients and show them that we could potentially place them again with the same bank, or take them to a different bank who uses different rental calculation formulas, which will then in turn make them much easier to qualify. And so, many clients come to us with this belief that 5 is the limit, and we'll take those same clients to 10. Last year, I took a client to 11 property, 5 to 11 in 1 year, after he thought that he was going to be stopped at 5.
Yeah, and I guess to make it very clear, you don't work directly for a bank. You work for a brokerage where you guys have access to different lenders, A, B, and C, and you essentially try and work on people's needs and fit them into what works best. So you're not you're not tied to one bank. You have access to multiples.
Yeah, that is correct, and that means that we have to almost know the bank's products better than they do, and also know, given this lender's client situation, which lender and which product. So it's a bit of a matrix, but we know generally those things inside and out.
All right, so let's jump into the the details of this conversation. So we know, I think the investors and the general public is aware of what's going on in the market in terms of prices decreasing year over year, month over month, interest rates increasing, causing, of course, having a negative impact on cash flows. And now recently with the U.S. Fed making an announcement on another interest rate hike, and now essentially the verbiage being that there's perhaps going to be more hikes coming to Canada in October and in December. So we have negative cash flow. That's obviously known, but what else is going on? So based on what people have in terms of products, right? So we have people who have locked into fixed rates, so they know what their situation is for the foreseeable future. But now we have this group, and I would say a large group of buyers that fall into the variable mortgage rates. And having some conversations with you, there are different types of variable rate. So it's not a one variable rate and you're done. Some banks will increase your payments, some banks won't, some banks will increase your amortization. So can you just talk about the different types of variable rates and what's going on with those investors right now?
Yeah, sure, happy to. So, and I totally understand why there's confusion about this particular topic. So I'm going to try and simplify the language so we can sort of all get on the same page here. So we have variable rate mortgages, right? But there are 2 types of variable rate mortgages. We have a variable rate with a variable payment, meaning as the rate changes, the payment changes. Okay, that's pretty clear for everybody. But separate to that, we have a variable rate with what I'm going to call a static payment. Okay, meaning that payment will not change in most instances, even if the rate does increase. So if we start the year and we've got these 2 products at 2 different banks, and the interest and the payments are $2,000 a month, for example, then what might happen over the year is the rates go from 2% to 3%. The first payment with the first type of variable rate, which is a variable rate with a variable payment will change. But the other one, which is the static payment, the payment will remain the same in most instances. But then I know what your next question is, but I'll let you ask it.
Go ahead, go for it.
So the question that someone will have is, well, what happens when the person in the static rate payment, the interest rate increases to such a point that the monthly payment, in this example, say $2,000, isn't enough to even cover the interest, okay? And so let's talk about this year. This year, some of you listening might have started with a variable rate at 2%. And right now, with the rate increases we've had 3% rate increase this year. So you've gone from 2% to 5% just this year, okay? Let's say in January, your payment was $2,000 and it has stayed the same this entire time. Some of you may be approaching that point where that $2,000 payment, which at the start of the year represented maybe $1,000 interest, $1,000 principal, okay? And then halfway through the year represented that $2,000 represented maybe only $800 principal pay down and $1,200 interest. So the payment stayed the same, but the way that the payments distributed between principal pay down and interest has changed, okay? And now we're at this point where maybe today the actual full $2,000 payment only covers just the interest. Or at that point, you're going to be getting a call from your bank regarding what they call the trigger rate, okay? And you might have seen this in the news, but there are some Canadians now in these variable rate, static payment mortgages who are now being contacted by their bank saying, listen, because of where you are on the payments and the interest, we have to make some changes. And what you've been paying is going to now have to change. So there are three ways that they deal with this, Saman. The first option that they have is that you as the borrower can actually give the bank a lump sum, maybe $10,000, maybe $500, whatever that may be, in order to catch up, to make sure that you're staying ahead of it, okay? The other option that they have is you could just convert and lock into a fixed rate, right, which is available on any variable rate. And then the last option is that you can simply pretend that now you're like all other variable rate mortgages with variable payments, and you agree to go into a variable rate, variable payment method. So they're the three options that people have, and really what's right for you will depend on your circumstances, right? And we've been helping people navigate that question. But just to be clear, not every bank has these both as offering. In fact, it's different banks are either static payment or variable rate payment. And for you to identify like what are you in, here's my suggestion. Look at your last 3 or 4 mortgage statements. If you've had a change in payment, then obviously you're in that variable payment. You won't be called about a trigger rate. But if your last couple of payments have been exactly the same, even though you know you're variable, you're in a static rate payment, and therefore you may be exposed to that potential trigger rate.
Do you know off the top of your head, like let's just assume, chartered banks, do you know which ones fall into which buckets?
Yeah, so for sure, Scotiabank has a variable rate and variable payment, right? So that changes as it changes. But the majority of others actually have the static payment.
It's interesting that one has decided to go one route and the others have decided to go another route. You would think that you would want to stay ahead of this and protect themselves and kind of, I guess, hedge against interest rate risks as it goes up to ensure that payments increase and they do in fact have people paying down their principal plus the interest.
Yeah, I mean, it does make sense for that to be the case. And I mean, let's just say this, even if we're not approaching the trigger rate, but we have increased rates, what happens if you originally signed up for a 30-year mortgage?
Yeah.
And suddenly interest rates bump a touch, but you're nowhere near the trigger rate, but certainly the distribution of principal and interest is now favoring more interest. Right. There's less principal being paid down. So that the crazy thing is at the end of your first year as a mortgage owner and you signed up for a 30-year mortgage, thinking that at the end of the year, you've got 29 years left. Depending on how these numbers play out, you might actually have 30, 31, 32 years left, depending on how dramatic that is. So you get into this, what they call a negative amortization scenario with a variable rate static payment.
Yeah. Dion, so in the event that you get a call from the bank, right, saying that, hey, look, your payments are not covering interest, and you give a lump sum, does that lump sum go ahead and cover the remaining portion of the interest, and then anything above and beyond that directly goes towards principal pay down?
Yeah, so generally they'll call you when you're approaching that, or just past it, right? So hopefully they're calling you and you're not like $50,000 in the red, right?
Yeah.
But yes, they're going to take care of the interest first before the principal. That's how most financial institutions will work.
And then would that because typically at the end of the year, you have a allowance to pay towards principal pay down. Do you still have that allowance as well?
Yeah, that won't change, right? So
Okay.
20, let's say you signed up and you got a 20% prepayment. You borrowed $1 million originally. So what that does mean is the $200,000 a year is still available as a prepayment privilege.
So Dion, what about the conversation or the thought that, in previous years when interest rates were low, right, you would never find someone saying, I'm working to pay down my mortgage ASAP. It was cheap money. Why would I pay it down? I'll go invest and make, 12% and gladly pay 2% towards my mortgage. Does that narrative change now? Do you have an incentive to work and pay off your mortgage quicker?
Yeah, so this is true. So let's just say right now your interest rates are at 5%. Okay.
Yeah.
Does it make any sense to go and invest 100 grand in the stock market, knowing that you'd have to make that 5% in the stock market or mutual funds? Probably most of us would be more conservative in mutual funds. And the funny thing is, in order to have that 5% gain net, you probably have to, depending on your income tax bracket, you might have to make 7 or 9% in mutual funds. And so if I've got 100 grand, I've got to either invest it and make 9, or got 100 grand and I can just pay down my mortgage, then yes, paying down the mortgage is probably the logical sense if they are the only two options. But the one caveat there, I would say, Saman, is that don't get rid or don't lose access to liquidity, right? If you've got 100 grand sitting in your bank account, it may not be the wise move in the current market to drop 100 grand on debt pay down. You may want to reserve a portion of it to make sure that for any bumps that may come, and we don't know how many more bumps are going to come, frankly, that you've got enough to ride yourself through. The general rule in financial planning is 6 months worth of living expenses accessible for you.
Yeah, I mean, I would go a step further and say, that 7% to make 7%, you're not even talking inflation. So I mean, technically, you need to beat inflation, and it's pretty difficult to do that right now.
Yeah, I mean, it's it's a crazy game right now where savers are losing as well, right? And so this is where I'm saying right now that protection component, protect and then prepare to prosper. Protection is so important. Like it may be the case for many of us right now that we're not looking to make money. We're looking to protect what we have and make sure that when the market turns, we're not scrambling at that point to get in, but we're prepared to get in, right? And many of my clients who have been doing this over the last couple of months, in the face of these interest rate increases and the knowledge that there might be more, they're still moving forward. It doesn't mean they have to buy something tomorrow, but many of them have found some great deals in the current market where people who have had to sell because maybe they've purchased a property and they're committed to close on that property in a month from now, and they have to sell their existing property regardless of the market conditions. So many of our first-time buyers and investors who were prepared have been able to jump on those opportunities.
Yeah, and Dion, with the assuming that there are going to be 2 more interest rate hikes here in Ontario, would that put the variable rate mortgages higher than the fixed rate mortgages?
So assuming that the fixed rates remain where they are, right? So that the spread, okay, let's talk about the spread. We rewind a couple of years ago, and I'm going to use round numbers. Variable was at 2% and fixed was at 4%. So there was a 2% spread. And, that at that point, it's worth taking the risk of the variable, right? And over the last year, it's sort of diminished a little. And right now, we are so close in that, again, using round numbers, the fixed rate is at around about 5.5, and the variable rate's at around 5.2. So we're at less than 0.5% spread right now. So that's where we are. Now, if the fixed rate was to remain the same, but the variable rate was just to increase by 0.5%, then yes, we would be in a case where the fixed rate would be lower than the variable. This has happened only once in the last couple of years. We've had this inversion. But if the question is, if what should we choose? Should we take a fixed? Should we take a variable? That's going to always be on a case-by-case basis.
That's right. Yeah, that's right. Yeah, I think case by case, and it depends on your time horizon of hold and what that strategy is. I think it depends on your income situation. If you're looking to refinance or renew in 2 years versus, let's say, 1 year, or even vice versa, even longer. So I think the key here is, you need to get on top of your paperwork in terms of knowing when your renewals are, if you need to refinance, and you need to have those conversations now, because you can start talking with a bank within 6 months of a renewal. Is that correct?
Yeah, 6 months. And a lot of people don't know this. Within 9 months, and this is important, if you're in a fixed rate and you're within 9 months of renewal, the penalty in general, the penalty you would pay to break 9 months out is, generally speaking, 3 months interest. Whereas usually it's this IRD, interest rate differential. So you don't necessarily have to wait to 6 months out. At 9 months out, I'd recommend you start talking to a mortgage broker, frankly, because the broker will be able to compare what your bank is offering versus the market, right? And then move you earlier. And we often do these calculations, and we find that the penalty that the client is would be exposed to pay may be worth paying based on their circumstance.
Awesome. Yeah, I guess you'll be going into more details as to what people should be doing more in terms of their mortgages with your workshop, September 27th, right? Tuesday, September.
That's right. Yep, 7 p.m. Tuesday, September 27th.
Yeah, I've sent it out to everyone that's on my mailing list.
Okay.
And we're hoping to see a lot of people there. And I think that's a great conversation for now. And as always, I mean, like we said, everything is specific to your scenario, to your income, to your debt level services. So if anyone wants to get in contact with Dion, we'll definitely have his contact information in our show notes. And Dion, what's the best way for people to connect with you?
Yeah, they could just email me at Dion, that's Dion, at mortgagesbydion.com, which might be showing in the bottom of the screen there. Or they could reach out on my cell at 647-990-8622.
Awesome. Yeah, there we go. Contact information's right there. Again, Dion, thank you for joining me on this chat. Really appreciate it. We'll definitely do more. And to everyone, thank you for watching. As always, if you can subscribe to our channel, and if you have any specific questions, drop them in the comment section below. I can respond to it. We can get Dion to respond to it. And if anyone likes to connect with me, my calendar link will be in the show notes below. Feel free to get in contact with me, and we can talk about what's in store for you. Awesome.
Great. Thanks again.
Thank you. Appreciate it, Dion.